Good afternoon, everybody. Welcome to our Investor 360 program. We had some technical difficulties this morning, so with the link getting into the room. So I'm responding to people as they email me to make sure that they can get in. But thank you for being here today. I'm excited because I've known March Capital since its inception, when its original partners moved from Clearstone over to March and created this new investment firm. And one of the great things that happened when they started March is they found this guy Jed Leidheiser, who's our partner with the firm and our speaker today. Jed has a great background, cutting his teeth on how to evaluate companies, working for Accenture, and learning that go-to-market strategy and what a P&L is and how to own it and manage distributed teams. All those skills were something that he honed in probably with Accenture, and then moved on to do some other things before he came to March Capital in 2016. So he's a graduate of the UCLA Anderson MBA program, and he's a graduate undergrad from the University of Virginia. We don't get too many people from the University of Virginia on here, so it's good to see some East Coast folks come and present. So Jed, without further ado, I'll let you do some self-introduction, and then we'll just get into it. You and I doing some back and forth Q&A, okay?
Yeah, Lynn, thanks for having me. That sounds great. I'm always excited to do these things. I think it's important to really help out the ecosystem, whether that's kind of entrepreneurs going through the process or investors or other stakeholders in the ecosystem. Look, I've been in LA since 2014, since I started business school at UCLA, and it's going to be my home long term. So look forward to meeting a few of you through this call and offline as well.
Great. So Jed, tell us, what inspired you to get involved in venture capital investing? How did that transition happen?
Yeah, look, I can give you kind of a long version, the short version. I think, kind of trying to bridge the gap between them. I was someone who was interested in kind of two things at a pretty early age, middle school, elementary school, and those were technology and then some level of business. Some of the vivid memories I have is, my dad bringing home a, IBM computer, kind of the early days, and just kind of being fascinated by what was possible to do with that machine, particularly when it was connected to the internet. And I remember our first service provider was Prodigy. Very early days, even before the schools, had internet access, at least our school did. And then I remember also in fifth grade, our teacher, somewhat surprisingly, did a stock pitch competition. And, we would look at the paper, and I remember very vividly getting second place in that, not really knowing what I was doing, but, choosing a company called Stone Container that was local to Richmond, and that company doing quite well. And so I think that sort of seeded my interest. And, as I went on to kind of the rest of primary school, I got really, fascinated by those things. I'd read Forbes, I'd read Wall Street Journal, mainly just because they were, around the house and I was bored. But also when there was kind of school projects to, find periodicals and do research, I would kind of gravitate towards some more business-centric publications. And then, by the time I came to University of Virginia, I did a double major. I started out in the engineering school, did computer engineering, which is a blend of computer science and electrical, and then tacked on a second major, which was economics. So for me, it was all about trying to figure out that blend. I found that, going through the interview process coming out of undergrad, consulting was very appealing. It was a way to get a multitude of experiences and different kind of client environments. And Accenture, as and those people know, is a very technology heavy consulting firm. So that ended up working out, very well for me. And so happy to kind of touch more on that experience. But I think, I was there for 8 or 9 years. And at that time I was in New York, and I was working for Goldman Sachs as a client and having a leadership position on that account. And I was just kind of fascinated by folks I'd meet either there, other places in the New York ecosystem, they did investing as their full-time job. And I was always attracted to that and had a personal account like many of us do from a fairly early age and wanted to do that kind of full-time. And so what I thought was, hey, I'd been in New York at that time for about 6 or 7 years. It was time to transition for me and go to the West Coast, which is always a place I wanted to live. And LA was in particular a place I thought was, highly attractive based on its diversity and its weather and a few other things. So I went to business school and I got out of New York, was lucky enough to get a scholarship at UCLA Anderson. And then I took a variety of internships. I mean, at that point in time, I personally did not know I wanted to do venture capital. What I did know was something quite close was I wanted to invest in technology companies. And so I was fortunate to take a bunch of internship experiences, first kind of pre-MBA with a firm called Workbench Ventures out of New York that does seed and Series A enterprise software. And then later with a private equity firm and then a hedge fund to see different parts of kind of the life cycle of technology companies. And kind of throughout those experiences in business school, it really kind of honed into me that, my skill sets, my interests were much more on the venture capital stage. And I really liked doing sort of, years 2 or 5 of the company. And in 2016, March Capital closed its first fund. I was able to meet a few of the partners here and just really hit it off. And so I was lucky enough to get an offer and kind of join the company. And it's been a fun ride since.
Yep, super. I understand that early education influence. I remember in elementary school, I had a similar experience, and we were selling things, and I loved selling, and I learned how to account for money using a ledger, and that inspired my interest in numbers. So I can relate to those early childhood experiences and how important they are in today's society. So, and we'll talk about that in a little bit because there is a bridge to that topic with March Capital. So as you came to March, what was impressive about March as you came in? A fairly new investment firm at the time, but not with new investors. What was the attraction? And talk to us a little bit about March and what differentiates March Capital from other investment firms?
Yeah, it's a good question. I think it's pertinent for the folks in this call. I was attracted by a few things. I think in this kind of game, this business, it is the people. I was attracted to what Jamie Montgomery and Sumant Mandal were doing. I thought first fund of 240 million was very impressive, and a big part of their focus was on enterprise software, which fit neatly with my background. So the opportunity to work for them, to be in LA, to focus on enterprise software. It was a deal that almost sounded too good to be true at the time. And since we've raised fund 2, raised fund 3, we've made a number of successful investments. We've grown the team, and I think it's a question that comes up a lot about how do you guys differentiate? And I think the easiest way if you're trying to do a quantitative aspect is to do some form of surveys with our portfolio company CEOs. But really the way we think about it is, having intense sector focus. We're very honest in saying we don't do everything, whether that's stage or whether that's, certain parts of investing. We're mostly enterprise software and fintech. And we're very deliberate in the investments we do. You won't see our portfolio having, 40, 50 investments. We really focus on kind of 20 or so investments per fund, really doubling down, taking time to kind of build conviction, and making sure we kind of back the best companies for the long term, and then taking advantage of our network. We're lucky enough and fortunate enough to have a number of folks in our ecosystem that are potential customers, potential partners, portfolio companies of past and present. They want to kind of give back and help newer portfolio companies, and we do a variety of activities to kind of support all those initiatives. So internal to the firm or internal to our portfolio companies, a better way to say it is we'll do things around kind of, becoming the CFO of the future. And that's kind of geared to our early and mid-stage companies. We'll take, a public CFO that's been through the IPO process and scale out an organization. We'll do the same thing on the sales side, hear from a very successful, chief revenue officer or head of sales. And they'll go through both, material that's, very valuable to our portfolio companies, and then answer, Q&A, and some of those kind of Q&A turned into, relationships between kind of individuals within the portfolio. And And then we're, I think, probably pretty famous, certainly LA region, I think, within private technology large for the Montgomery Summit, which was a conference started by one of our founders, Jamie Montgomery, and has continued. So we just hosted that kind of at the end of May. And that's an opportunity for, 1,000+ people to come together to hear about all the latest and greatest that's going on in the technology ecosystem, hear from 100+ companies, have one-on-one meetings, have keynotes from some of the world's top CEOs in software, and then have panels on a variety of topics, whether that's kind of, AI and cyber, or whether that's, data infrastructure and e-commerce enablement, areas that we cover at March Capital. So I think it's, being very focused, being very deliberate, not getting pulled in a million directions, and then bringing network to bear that, really adds value to portfolio companies we invest in.
Sure. And, you've mentioned enterprise SaaS as kind of your core competency and your core investments within the core fund. You also have a gaming fund that Gregory Milken has his hands in and focuses on the gaming industry. And I just say that as an aside because, I think that's an important component of what March does too.
100%. Yeah, Gregory's one of the co-founders of the firm, and he leads that gaming esports initiative. And very, very exciting. A little bit earlier stage than the core fund, but to the extent that folks have interest in that area, totally under our purview.
Right, and a great partner for folks that are looking in that gaming space. And Gregory's an awesome guy. So we talked about industry and sector. Let's talk about stage, because I think that's important to the people who are listening to this, is how do you determine stage and what does that actually mean? Because those terms have changed over the past 15 years. If you're doing a pre-seed or seed fund investing, 10, 15 years ago, those numbers are very different than what they are today. The same thing with an A round. How do you interpret stage and what does that mean?
Yeah, there's a variety of rules of thumb. I mean, we talked about this a lot internally over the years, and how do you communicate that to an outside audience? We've certainly seen a lot of deals in our portfolio and just ones we've looked at, and the letters sometimes don't mean the things you think they mean or don't mean what they used to mean. So the way we think about it, and the best rule of thumb we talk about, is kind of years 2 to 5 of the company. And so, kind of year 2 and beyond, we're really looking for product market fit. We're not looking, as March Capital for founders that don't have a product yet and, haven't achieved that or are trying different areas. Our value add, to put simply, is really helping these organizations scale and become market leaders. And so that's kind of how we kind of bound the problem. We're also not investing, in the public markets as our initial entry point. And so I think that's the way we think about it a lot. So usually, they have a leadership team kind of built out. They have, revenue. They have, traction of various means, and they just realize what they're solving, and they know what they need to kind of add to the mix, whether that's kind of leadership hires or kind of product roadmap, et cetera. So, what we look for is kind of, large expanding markets. We want to invest in growth areas. We want to make sure we invest in, products and offerings that are just mission critical to a business. The common refrain you probably heard before, at least the folks in this call, some of them have, is we're looking for the painkiller, not the vitamin. We want something that has a sense of urgency, not a nice to have. And I think that's even more important in the environment going forward. And then we're looking for companies that become, market leaders. And so there's this, power law in venture capital that's, a small number of winners really kind of make up, any venture fund. And so we're looking for the potential to do that, not just a company that's going to go from, something small to something bigger and kind of enrich that, entrepreneur, but, companies that have potential to IPO or otherwise become kind of, massive kind of growth engines of the economy.
Yep, that 100x investment. So, as you describe that, what occurs to me, and as I coach entrepreneurs and what those rounds mean, it's really it comes down to the use of funds, and I think you articulated that. It's at that point of your company, what are those use of funds? You've built out your team. Now it's time to scale, and that's really what that AB round is going to do. Probably the B round is going to do it more than an A round. An A round might help you build out that team, because that may be the point where, oh my gosh, we're starting to scale and now we need 50 people. So how do we do that? And that's where that money can be applied. So do you have a typical size of round that you like to do, and do you lead rounds or do you prefer to follow?
We definitely prefer to lead rounds. And so that's certainly the vast majority of investments we do. The other way we think about it is we want to have meaningful checks. So sometimes that's not getting the official lead credit, but that's certainly doing a significant investment. And then look, our last fund was 450 million. So we do around 20 companies per fund. So you can get kind of a sense of the check size. Certainly a company that's raising kind of year 2 of the company, which could be an A or a B, that round is going to be, smaller than, a late stage investment. So it sort of depends. If you're leading, what we found is it's kind of 40 to 50% of a round. If you're following, it's a meaningful size, and that may be, 10 to 20% of a round, just kind of as rules of thumb.
Good. Are there other firms that you like co-investing with from a relationship standpoint, or as far as bringing deal flow to you or bringing deal flow to them?
There's a lot of good firms out there. And so, I make it my mission to really have a good set of, standing meetings with both kind of upstream, VC firms, as well as kind of downstream firms that can follow on. And it's good that the ecosystem and, the COVID or, post-COVID, arguably, ecosystem is opening back up again. Like I said, we had our Montgomery Summit, 3 or 4 weeks ago now. I was up in the Bay Area last week for a conference called RSA. And so it's a good opportunity to kind of meet a lot of these folks. What I would say is, hey, we're not laser focused on saying, hey, these 2 or 3 firms, we have super tight relationships. I think now we're at a scale where we have, 36 people in the March Capital organization. And one of the benefits of that is we have relationships at the firm level, and then we have a variety of relationships at the individuals level as well. And so we can bring those to bear and kind of find the right partner for certain firms. And so there's a lot of good firms in the LA ecosystem and both sides of the equation, particularly kind of the upstream kind of seed funds. And there's a lot of other folks, whether in, LA, the Bay Area, and New York, kind of elsewhere, that we love working with.
Excellent. So you mentioned COVID, and, here we are in 2022, exactly 2 years after we closed down basically society for a number of months. How did that affect what you were doing in the investing world? And did it change the pace, or did it change how you looked at companies? And were you able to initiate investments, I guess, not necessarily make the investment, but initiate investments 2 years ago? I know you had stuff in the hopper that you probably were able to fund, but how did you approach the idea of finding new companies?
Yeah, I mean, it was a kind of a once in a generation type of event, right? That we all lived through. And so we certainly hope, and maybe Bill Gates thinks differently than that, but we'll see. History certainly rhymes, and we'll see if there's a repeat of that, of a similar event or not. But anyway, back to your question, I think a few things, right? I think anytime you're having like a fundamental shift in the market landscape, you just need to kind of take time and assess what's going on. You don't want to move too quickly to do anything, I would say, net new. At least that's my kind of personal opinion. What you really want to focus on is the portfolio itself. And so that's certainly what we did, right? We looked at our portfolio and did some scenario planning at, first the, company kind of bottoms up level, and then aggregating that up to, the fund and firm level, and making sure that folks just were prepared for that new environment. And, a lot of that kind of goes into having the right runway, but, certainly in that environment too, there was a big sort of cultural component as well, and how a founder is going to be able to manage that. And so we had, sessions with our portfolio companies. We got portfolio companies together for kind of group sessions, folks we thought could have a thought leadership perspective and had been through maybe not the exact same scenario by any stretch of the imagination, but had, led companies through a variety of macro circumstances and how to address that. And then on the new investment side, certainly there was companies that were, still in the hopper, or you want to make sure you're getting the right valuation relative to the risk or volatility type environment. And then we also want to make sure that we're, being open to new investments. And so I think the most basic thing that we had to kind of learn was, how do you build these relationships? How do you evaluate when it's an online format where you're not kind of spending time with these folks in person? And, I think what we learned is, you can develop, strong relationships through Zoom, through meeting, multiple members of the team, through doing classic things like, background reference checks, talking to existing board members, existing investors, and the like. And so that's something that a muscle that we've kind of built over that time period. So I would say it's something we've learned how to do and certainly practice on a regular basis. But at the end of the day, like I'm more drawn, come to the office on a regular basis, like much of our team does, to kind of the coffee sessions, kind of hashing out things with entrepreneurs. And I think the sort of earlier you go, the more important that is, but you can never really sacrifice on team. So you need to make sure that you have that dialogue, that relationship. We're looking for, not just companies that can be great, but founders who are like self-aware and founders who want to work with us as much as we want to work for them, because we feel like that brings the biggest dynamic and potential for building a big company. And so that's certainly easiest to do in in-person environment.
Sure. Was there any particular deficiency or challenge that portfolio companies identified in COVID that March was able to help them address, other than just bringing them together to kind of have that group therapy of founders working together through it? Because at the end of the day, that's what it was. It's wow.
Yeah, I mean, look, it was a crazy time. And I think it's a few things, right? I think that the cultural, how do you motivate your team? How do you keep them productive? How do you keep them engaged? I think that was one of the super themes. I think the other one, particularly for us who do enterprise software, and a lot of the enterprise software companies historically and still today have a top-down sales motion. And if you have that kind of motion, then you're usually doing a lot of field sales. So you're having, feet on the street, and those sales reps are visiting companies or doing kind of shows and conferences, et cetera. And that obviously all came to a halt. And so there's a lot on, how do you reach these customers? And I think early on, no one sort of knew what was going to be effective. I think what we found out is that in some ways it was easier to reach these people than ever before, right? You didn't have logistical challenges of the in-person or the travel, et cetera. And if you had the right crafted narrative, then you were in a good position. I think we're also fortunate to say, hey, the areas that we were invested in are pretty structural and secular trends that are long-term, and those were actually accelerated by COVID. So, in cybersecurity, there's certainly a work from home component. There's more data being generated, so you need to have the infrastructure, you need to have the AI models. Some of these things were accelerated by companies wanting to be moved to the cloud, wanting to be kind of digitally transformed, wanting to enable their employees to work from anywhere. And so in some sense, a lot of those trends actually came towards those companies, and those companies were able to, I think, capitalize on a lot of that.
Excellent. I'm working through a technical issue that I hope to get resolved in the next 5 minutes so we don't get shut off. And I figured out why we needed passcodes. Anyway, regarding COVID, those are all great things that you're able to do, and obviously came through the other side, but there's been some changes in how people work. And we were talking about this early on this morning. People coming back to work, not coming back to work, how is that affecting productivity and ability to scale? And just from your observation, Jed, how do you see teams performing in this new mode of, well, we're going to have a distributed workforce in 5 different states or 2 different countries? How are people coping with that?
Yeah, it's a good question, because in some extent we're all sort of figuring it out. And so I think depending on the culture of the company, it really varies. It's easier to speak from kind of my personal opinion. I was told, and some of these things you kind of learn through life. You don't remember where they came from, they teachers or parents, et cetera. But it's good to be in the office. And when I was coming out of UVA and had a job offer for Accenture, I had a choice of which office I want to go to. And in that case, in that time period, I should say 2005, Chicago was the unofficial headquarters for Accenture, and so that drove my desire to start out in the Chicago office at Accenture. And the model for consulting is you travel Monday through Thursday, and then Friday people would make a decision whether they wanted to work from home or be in the office. And I know what I did the vast majority of the time is work in the office, because that's where you're meeting the more senior leaders. That's where you're getting pulled into kind of RFPs and one-off projects and various kind of other interesting initiatives. And I think a form of that is still true today. You're going to get more serendipity. You're going to build stronger relationships. You're going to get exposed to more and have better teamwork concessions if at least part of your day is, or part of your week, I should say, is in the in-person environment. And so that's by and large what we're encouraging. That's what we're doing here at March Capital, making sure everyone comes in a few days a week, certainly when they're in town. And that's generally our advice for our portfolio companies. I think if I had to kind of characterize what I see the most is, some form of that. Companies will have a set of regional offices, right? They'll have a headquarters and they'll have like one or two others. And then they'll do kind of regular sessions where they buy lunch or have activities that encourage people to come to the office. And I think the more of a, it's kind of both sides, right? The more of a leader you are, then I think leaders should go in the office, because that sets the example for the team. But also if you're a new employee to an organization, and I'm sure there's sole contributor roles out there, and maybe that's true on some development team roles, but for the vast majority of other folks, if you're in the office, you're gonna learn a lot more. You're gonna be exposed to a lot more. You're gonna get some more time. So I think it's just kind of figuring out what's the right blend for the right culture for firms going forward.
Great, great advice, and I think people can learn from this experience and really learn how to improve their teams and still deal with the issues that employees have and their concerns of coming in, or just the fact that for 2 years they didn't have to, and that's all they know now. So that becomes a challenge. So we're all working through that, I think, whether you're working for a venture capital firm, a portfolio company, or a law firm, we all have those same challenges. Let's switch gears. What's going on with valuations from what you're seeing and what you're hearing? I'm reading that valuations are starting to come down and come down to a more reasonable level, at least on new deals. Do you see that happening, or is the high valuation still the day?
Valuations have definitely come down. It is a different story for different stages. I think, we're all witnessing what's happening in the public markets the last few weeks and months. And you saw what happened on Monday and last Friday, where there was a significant, derating of a lot of the software multiples. And so, that has the most effect on sort of the later stage companies that are, thinking they're going to IPO in a year or two. That's sort of off the table. So those deals are just slowing down in the broader ecosystem. And you see that in the data, where you look from Silicon Valley or PitchBook or some of these other providers that do the aggregate. And it's slowly filtering upstream. We're starting to see it in the deals we're looking at as well, where there's companies that we passed on for valuation reasons. And some of those companies are coming back to us and saying, hey, maybe we'll open up the round because they want to extend their runway, or they'll do a slight uptick to the last round. And so I think there's going to be some just great opportunities. What I will say is that, as much as I think there's coverage of this from, VCs writing blog posts and, CNBC articles and Twitter and everything else, not all founders kind of truly believe in that re-rating just yet. They think it's, hey, I'm only a Series A or Series B, and what happens in public markets is so far away, it hasn't really affected me yet. And I think my advice would be like, look, there's a 99% chance it will. There's always outlaws or outliers, but that's not something that you should assume is going to be you. And so just expect the valuations to be more of the pre-COVID, the kind of the 2015 to 2020 sort of valuations, not what was heightened in a zero interest rate sort of environment. So, for us, I think that there's going to be some opportunity to get into companies at very attractive valuations. And I think that's going to be a plus for, everyone going forward.
Sure. And one of the things we spoke about yesterday was as the economy is changing and tightening up, and interest rates obviously are going to go up. The Fed raised the rate another 3/4 of a point today. Is that cause for concern for portfolio companies moving forward and being able to scale as there's a contraction, or is it going to show an opportunity? And maybe that's industry specific.
Yeah, I think it's industry dependent. I think it's also very focused on individual companies, but it's probably useful to talk more on a broad spectrum. I think the kind of number one advice we're giving is making sure you have sufficient runway. That can really help things out. And you can achieve that by, certainly two core areas that have lots of permutations, right? It's adding money on and figuring out what the right valuation to do that is, and deciding if that's equity or debt. And then it's hopefully in a combination with reevaluating what you're spending on and making sure that spend is appropriate for the kind of next stage of the market. All markets are a little bit different. I think most people would agree this kind of market the last 2.5 years was mostly focused on growth at the expense of profitability, and that is rapidly changing. And so things like unit economics, path to profitability, just efficient growth overall is going to be sort of more and more important. So I think that's kind of the things I would focus most on if I was a founder, right? I think it's really focusing on your customers. For the folks that have product market fit, making sure you're kind of measured with how you're building out your sales organization, how much you're spending on various kind of marketing initiative, and which ones show the most value. It isn't the time to do 5 or 10 things at once and throw the spaghetti at the wall and see what sticks. It's a time to be kind of deliberate about what you're doing.
Super, great advice. So we have 20 minutes or so left. I wanted to talk a little bit about your portfolio and what excites you. I kind of laugh because it's hard to pick you don't want to diminish everybody in the portfolio by picking a winner, but is there one particular company that you're really excited about and has real potential for growth and a potential exit?
Yeah, it's always an easy and a hard question at the same time, because I know the portfolio well, and there's a vast majority of the portfolio we're super excited about. So maybe kind of the sense of deals that I'm more involved in, and some that are more recent. There's a company called Immuta, IMMUTA, and they announced a round recently. We originally invested last year. And I would say what their core value proposition is making data, which has become the most important asset of a business by most definitions, shareable and secure. And so they have a solution that works across databases and cloud platforms, et cetera, to make that happen. And they're focusing on kind of the enterprise layer, and they're doing that through a mix of security, privacy, infrastructure enablement, and then the team. It all starts with team, right? So it's a founder that we've gotten to know through the years. He's been a frequent presenter, this guy, Matt Carroll, at the Montgomery Summit, who was originally helping out with intelligence operations in Iraq, and became highly referenced by folks that we knew from kind of the defense forces. And it's someone who's, as he kind of proceeded to get more adoption and kind of refine his vision, made sense for March Capital to invest last year. And it's a business that's just taking off, and one we're super excited about because it's kind of marrying two things that we believe are very strong in the enterprise today. It's data and security, and those both are going to hold up regardless of the macroeconomic environment. So that's certainly one that comes to mind. Another one that we did for an entry point last year is a company called Expel, EXPEL. This is firmly in the cybersecurity landscape. And I think what we're seeing here is there's a cyber skill shortage. There's polls that kind of talk to the CIOs and CISOs of these organizations, and they rate kind of what their main problems are of achieving their visions for their org. And 70% of the time or more, you're having a shortage of skills on the team is something that's really affecting them. The other things that you'll hear near the top of the list too are when there is a data breach, it takes too long to discover and to triage. And there's just too many alerts coming in, at all the time to effectively kind of manage everything for really any size organization. Maybe Google or Goldman Sachs is a little bit easier than some others, but for the vast majority of folks, it's still hard. So what this company does is offers a product called Managed Detection and Response. It's a managed service. but they use an AI-driven platform. It's software that uses machine learning to detect across all your existing cybersecurity tools, correlate across those, find the attack, recommend a response. Even they offer the ability to do the remediation itself to kind of plug the hole. And then it's a platform, right? Not only do they do this across the tools, they can offer vulnerability management on top. They can help you secure some of your posture. And going back to the team aspects, a team that became best in class at Mandiant, which is a leader in incident response. The CTO from that organization, Dave Merkel, and a variety of folks that they've added to the team from a go-to-market perspective in the last, call it 6 to 12 months, that can really take that company from being good to great in our eyes. So I think those are kind of two that pop up where it's, hey, the market's ready, the team is right, and it's a product that's performing. And so, now's the time to still be efficient in your growth, but to make sure you're not sacrificing growth by any stretch of the imagination.
Super. And as you evaluate companies for investment and you're looking at teams, what are those qualities you find in that CEO that make an investment easy or easier? And then conversely, as you're looking at companies and CEOs, what are red flags that definitely would give you pause in making that investment? So let's go with what's good first, and then we can talk about what are some of the challenges.
Yeah, I think, high level sort of, do I take the meeting or not? Some of it's, how you get referred to the opportunity. I won't say that's not true. That's a piece of it, but more conceptually, it's large markets that are expanding, mission criticality, the painkiller I mentioned, it's fast growing and it has the potential to become, a market leader, a platform, which we can talk about on a bigger basis. I think on a team perspective, I'm always interested in folks that really have a unique insight into the market that we're looking at. Often that can come from, particularly enterprise domain, someone's done something similar. Maybe they work for a large organization, identified a problem, and they want to spin out a company or start a company to address that. They can also be someone who has more of a beginner's mindset to an issue. They're going to partner with the right technology co-founders, et cetera. But they're coming from more first principles standpoint of why hasn't this been done differently? And I think that's really important. So I'm looking for in some sense to get kind of intoxicated by the first meeting, but from evidence and substance that's valid. So instead of saying, hey, here's a 50-page pitch deck or here's kind of no pitch deck, I'm looking for someone who's even a market that I'm familiar with, kind of educating me on something that's sort of basic, that's overlooked, and a different way that they're going to approach building a solution. So I think on the green flag side, it's those. We talk a lot about kind of storytelling capability, and that's really a proxy for their ability to raise money from VCs like us now in the future, the ability to make large sales, and the ability to kind of track that A team that you mentioned.
Great. So let's. What are the red flags? What do you run away from quickly?
Red flags, there's quite a few, and I think a lot of these you see kind of in the first 5 minutes or so. I think where they don't really have a unique insight, right? It's too high level in terms of what they're doing. That's one red flag, right? They just haven't kind of thought through the problem enough. They haven't kind of tested it by going out to folks and soliciting opinions. I think the other thing is where it's really a product, or maybe it's even a feature. It's something that we believe is going to be, maybe it does sell a pain at some level, but it's most likely going to be a small outcome. And then I also see folks that I feel like they're just looking for a quick buck, right? I mean, they'll say, hey, I think I can, sell this thing for 2 or 3 times, or, I've already had acquisition offers, and they just don't seem to be in it for the right reasons. They're not trying to really build something. I think that companies are bought, not sold. And that's kind of a core belief that I've developed over the years, both from inside, Fortune 500 organizations and now from VCs. So I want that someone that's, in it for the long term. So I think if, it's kind of the converse of that, right? If I don't see those things, that's really a red flag. And then it's evaluating sort of the team around them, right? We don't want the, total individual that thinks they're going to do it all. You want folks that are very self-aware and knowing kind of where their boundaries are. And it's often more important to have, a few special skills and be really knowledgeable about that. And you can complement that with co-founders, leaders, than to, think you're going to do everything as, as one, CEO founder.
Super. All great insights and very instructive, I think, to everybody on the call. So, Jed, what haven't I asked that you think is important for people to know about venture capital, about March Capital, and about yourself?
Yeah, a few things certainly come to mind. I think when folks are, and I imagine some of the folks in this call are evaluating their business and planning on raising money, be very deliberate about kind of the VCs you go after. Think about the firm context, think about the individual context, really have a sort of try to build a dialogue, try to educate that investor is sort of the best way I found for founders to really kind of tap into VCs. Certainly warm intros help, but to the extent that you're not doing that, think about that. Not every investor is sort of right for you. So, figure out when you need to develop more energy and figuring out when it's time to move on. I think in terms of managing the business itself, it's easy to say extend your runway. It's easy to say probably, focus on the customer, focus on one or two things. I think the other thing I would phrase is just like you've got to figure out how to kind of keep, as an entrepreneur, keep the magic in what you're doing. And I think that goes to kind of employee morale, but also goes to kind of the external perception of your company. I think that's a core job of a CEO, and an environment that is a little uncertain that we're about to go into. That's something that has to be, upheld. And so a lot of that is being self-aware, making sure as a CEO, you take care of, yourself first in terms of making sure you have the motivation and, the sleep and, good health and all those things, and making sure you're kind of projecting that on the outward side. So I know those are kind of a few things that come to mind. I think it's also worth saying that great companies are often built in challenging or volatile times. And I think that's going to be very true here.
Super, great advice. We have time for a couple of questions, but the way I want to do questions, if you have a question, please put it in chat. And that way I can have some screening ability. So if you do have a question, put it in. And while we're waiting for questions, I think the one place that we didn't explore, we talked about how you select deals and how you select founders and the pitfalls and the advantages of good skill sets. What is there a deal that you missed ever, that you said wish that you got into, that you didn't, that you passed on?
Yeah, look, I mean, we hold this event called the Montgomery Summit, and I mentioned there's hundreds of companies that come through there every year. A variety presents and a variety are attending, and so I think there's a lot we've seen that kind of blew up in a very positive way, and maybe had a high valuation at the time, and that could be like a Chime, that could be like a Big ID, some of these other ones, and it's just hard to kind of make the decision sometimes when the valuation is high or when you see there's a lot of other competitors out there. So I think every investor has sort of an portfolio out there. Those are kind of two that come to mind. And the good thing is, I think about kind of the public markets a lot and what the analogies are, right? If you build a good portfolio of public stocks that do well, that's great. You don't have to be in every public stock that outperforms. That's right. And so, certainly have a variety, and you kind of learn from those experiences.
Great. I know what I wanted to ask you, and it goes back to our comment at the very beginning. March Capital has a foundation, and I think that's something that's unique to a venture capital firm, and you do some community, giving. And I think that's an important thing to just mention. And I didn't know if you wanted to comment on that. I think from someone who comes out of that sector, the nonprofit sector, having somebody who is out there helping companies create wealth and solve problems. And a lot of the problems that tech solves doesn't solve the humanitarian problems that we have today. And I just find it interesting that March Capital is willing to invest some portion of its return into the community to help solve some big problems.
Yeah, look, I mean, I think community engagement has always been something that's a personal interest of mine, and it's really been a hallmark of March Capital as well. And so, certainly for the first few years of our firm, we're always doing some level of that every year, and it was always work and organizations we're very proud to support. And then in 2020, we formalized that. We formalized that through launching something we call the March Capital Foundation, and that provides funding and help to kind of at-risk groups that are in the broader kind of Santa Monica, LA community, and also kind of folks in the broader kind of innovation economy. And high level, kind of how that works is we donate a percentage of our profits to help those at-risk groups. And so, a few maybe I'll highlight is one's called the People Concern. We've been supporting that organization since 2014. They hold an event that folks may know about that's around kind of Thanksgiving and feeding the homeless. They do a variety of housing, mental and medical care, and assistance and psychological services throughout the year. And so we're happy to support them. Another one that comes to mind is the Venice Family Clinic, who really focuses on healthcare and medical services to other need. But there's a variety of other organizations we kind of help out with, whether it's supporting entrepreneurship at Claremont McKenna, helping out with the LA Metropolitan Debate League, where I've been a judge a few times. And our goal is to really take a similar kind of view of the community that we take with our portfolio companies, meaning take leadership, be very involved, give resources, focus on a few concentrated portfolios or concentrated programs, I should say, where you can make an impact.
Well, on behalf of the community, thank you for that, because I think it's really important and it's a great model for other people to follow. We do have a question here, and I'm going to conclude with this question. On your website, you use the term e-commerce enablement. What does that mean to you, and what does it include?
Yes, it's a good question, because it's a pretty new term. And I think what we're seeing now, and we saw it particularly in COVID, it was just acceleration of that trend. You're seeing kind of offline, more retail, brick and mortar commerce move online. And so how do you enable that in an easy way? One example of a portfolio company basis is we have a company called Forder, and what they do is help with fraud prevention. And so making sure that legitimate transactions go through in a process by merchants, and on the opposite direction, right, making sure that fraudulent transactions of various types are blocked. And so that's something that e-commerce merchants really kind of need, and it's a core part of their stack. But there's a variety of other things as well, right? There's shopping cart services, there's headless commerce, there's kind of loyalty programs, there's marketing to engage folks in the kind of e-commerce. How do you kind of reach those folks? How do you increase the order size? How do you decrease the abandonment of carts that frequently happens? And how do you kind of customize the curation of goods and services offered online to kind of the individual themselves based on their kind of profile and wants and needs, et cetera. So it's kind of a merge of two things, right? By definition, it's the kind of e-commerce domain itself, and then it's what we like to do really across portfolio, particularly is kind of infrastructure software. And we believe infrastructure is a needed piece that allows services and applications to be built on top. And it's where a large part of the value creation is gonna be captured, right? It's sticky, it's kind of hard to rip out, kind of once you're in, whether it's a Twilio for text messages, or whether it's kind of Stripe for kind of payments and the like. Those things become massive companies over time. So it's supporting the merchants that offer goods and services online, and it supports those who want to transition from kind of offline to online work.
Super. Jed, thank you for your time this afternoon. I appreciate it. I said we would end by 1 o'clock. We're a couple minutes beforehand. I want to be respectful of your time. So thank you very much on behalf of the firm, Stubbs Alton and Markleys, and our other partners in our Investor 360 series, TriNet, Silicon Valley Bank, Early Growth, and the California Marketing Forum. We thank you.